Good morning all. Nice to see you all here. Topic for this morning with myself, George Hallmey, is money, trade, and emotional management. Now, you might well think what all of those three things have to do with each other. Well, the money management aspect, we're drummed into us that we've got to make sure that we don't lose money when we're trading. And of course, trade management is the all-important part, which will mean that hopefully the money management is going to lead through to profitable trade. But then there's the emotional side of it. And it's the emotional side of it, or the psychological aspect, which really does sort out the professionals from the amateurs. People who are new to trading frequently just don't get it on the emotional side of it. And they just don't realize that there are all sorts of things which will guide us to do, at times, some crazy things. And of course, that's the aspect that is the one that is the most difficult to get to grips with. However, let's just work on this and work through the various slides. First of all, it's rather important to be able to set up our trading business with a plan. We've got to have a business plan so we know where it is that we're going. Whatever business that we decide to go into, we might want to take on a McDonald's franchise or just take on a bin cleaning franchise. Whatever business it is, we've got to have a plan that tells us the amount of money that we're putting into it, how we're actually going about the business, and so forth. And particularly, if ever we went to the bank to actually borrow some money to run a business, then that's going to be the very, very first thing that the loan officer at the bank is going to be asking for. By the way, don't go along to a bank and say that you're going to start up a trading business. Would they sort of lend you 100 grand? It won't work, believe me. Right, now the headings are going to be the amount of risk capital that there's going to be, stated aims, risk parameters, etc. that we're going to get onto in a second. We want to have some rules there for what we're going to do with putting money in, taking capital out. You know, you might decide that hopefully when we get to the profit making months, then you're going to take out part of the profit, maybe 50%, and never add capital as it assumes losses have been made. So one would want a paper trade until coming back to being profitable paper trading before actually committing funds. So the last thing that we want to do is to put good money following bad. Now the trading time frames, swing trading is going to need completely different risk parameters in terms of the amount of capital, size of trade and so on. And it's going to need a completely different approach to that of intraday trading. Are you going to trade that early morning session that I frequently do get involved in, or indeed not? And which strategies are going to be followed? Is it going to be based on fundamentals? Is it going to be based on technicals? Which particular setup? Is it going to be multi-point reversal, range breakout, and so on? It needs to be detailed so that the brain has got something very, very straightforward to follow. One of the worst things is for a trader just to be looking at the chart and thinking, well, what am I going to do today? Oh, how am I going to trade it? Oh, yeah, I seem to remember reading in a book about 6 months ago something about a little candlestick setup. Oh, yeah, well, I think we'll do that. That sort of approach is a recipe for disaster. So clarity is most important. Detailed trade management rules, well, let's get into those and have a look at them. Well, I mentioned here the discipline word, which is all important. And I'm stating that it's the key to consistent profits. Now, many people just really don't have much self-discipline. They'll just meander along, and whichever way the wind is blowing, that's what they'll do. You know, they may well, trading-wise, pick up a few comments, tips from the newspaper, have seen an email from somebody saying that, oh yeah, we think that so-and-so is going up, and they'll buy just based on that. Again, that approach is going to just result in disaster as well. So the discipline to follow these rules is absolutely vital. And we'll look at some of the ways in which we can go about making sure that we do stick to disciplined trading rules. So let's just look at some risk parameters. Now, it's widely stated that 2% is the maximum amount that one should risk on any one trade. And with that, you can sort of link one or two other rules: the maximum number of trades at any one time, no more than a 6% risk. So that implies maximum of 3 trades on at any one time. Now, I've put in brackets there, ideally the risk wants to be no more than just 1%. If that can be 1%, then that's half the original risk. And some people say to me when I mention this, but am I not limiting my profits by only limiting my capital that I'm going to risk on any one trade just down to 1%? And well, yeah, that's absolutely right. But what we've got to do, because trading can very, very quickly damage our wealth, it is so easy to actually lose money, then what we've got to keep in sight of all the time is what the maximum possible risk could be. Never ever really worrying about what the maximum profit is going to be. The profits tend to take care of themselves, provided that the risk is very, very closely and carefully adhered to. So let's just look at this example. Right, we've got a 30 grand account, and so at 2%, then the maximum risk on any one trade is 600. Okay. If it's only a tenth of that, if we've only got 3 grand, then the maximum risk, let's just chop a zero off the end, then it's 60 quid, $60. So $60 then is going to be the maximum that we're going to risk. And then we also want to set an amount that we're prepared to lose each day or each week, assuming that maybe we're doing swing trading as opposed to day trading. And let's set a maximum loss of that one, which is going to be something like this 3 times 2%. Now, the other aspect is that so often, and I don't know if any of you guys have been in the position where you put a trade on, and it's been a brilliant trade. It's actually gone in your direction, straight out the starting gate, whizzing up into profit. And then, for whatever reason, it reaches a point at which it doesn't go any further, and chances are you go off and have a cup of tea or come back the next day and find that when you actually come back, all that paper profit that you were looking at earlier on has now dropped down to a loss. And then eventually the stop loss gets hit. Ever happened to any of you guys out there? Certainly happened to me on a good many occasions. So then I've just got a little rule. It's a fairly simple and straightforward rule that when I've got paper profits, and if those paper profits are ratcheting up, I don't want to give back anything more than around about 30% of those profits. I'm in the game to make some money, and if I've got paper profits, I want to convert at least a part of that. I'm going to convert part of that into real profits that are going to be tucked away into my account, rather than see the possibility of it just whittling away back to zero profit, or worse, some form of loss. So there we go. So if I'm in profit by 100, once the trade comes back to around about 75, I want to be taking at least partial profit. And indeed, I'm probably going to be taking partial profit before that actually happens. Right, now the next aspect that is something that I never used to do when I started out trading. I used to just go all in, all out on a position. My approach now, though, is that I will always trade in multiples, usually in a multiple of 2 or especially 3. So if I'm trading standard forex lots, then that's going to be 3 standard lots, or indeed it might be 6 or indeed 9. So I've always got this sort of multiple that means that I can either add and I can subtract as I go along. So there we are. Maximum risk 600. I'll divide it into 3 units. Okay. Just look at a standard FX contract. If it's $100,000, then I'm going to be either making or losing $10 per pip of movement, either way. So there we are. Maximum risk is 20 pips for a day trade, 3 contracts, risk of 600, implying that we've then got that 30,000 pot. So that's just how the breakdown follows through. Now the alternative to that, of course, if we haven't got a 30 grand pot, then you trade mini contracts, or indeed you can come down to micro contracts. Micro contracts means that a micro contract is even going to be less than risking $1 a pip. It goes right the way down to just 10 cents per pip. So no matter what the amount of money is that the trader has got prepared to commit, you can just apply this money management rules, whether you're putting in $1,000 or you're putting in 200 grand. Now that previous example then, let's just go back to that a second. Previous example there, we've got a 20 pip stop, and we're just working this so that we're not going to risk anything more than that, in this case, this $60. If the technical stop doesn't lend itself to being just 20 pips away, but maybe we're now going to be looking at a somewhat longer term trade rather than trading off, say, a 5-minute chart where, yeah, we can get away with a 20 pip stop. But if we're now trading off, say, the half-hour chart, then the technical stop's going to have to be wider. So if we've got to go for a wider stop, then we're just going to reduce the same pre-unit position, but the size now is going to be smaller. It's going to be half the size. So the maximum 2% risk is not going to vary. It's still going to be exactly the same. So there we were. It was then $3 times 3 times $10 per pip. So we were risking then that amount, maximum risk then at 20 pip stop, allowing us to go as far as 600 quid down. But now what we're doing, we're just cutting it in half. So rather than trading 3 standard lots, what we're actually now going to trade, we're just going to trade in the smaller lots, and so we're just going to be risking exactly half. Now, if we're going to spread bet it, then that's a dead simple way of doing it. But instead of trading full lots, we can then just drop down to mini lots or indeed micro lots. So the idea of trading in multiple units, then greater flexibility, loss reduction. If a position has gone into profit, then it enables the trader to maybe just peel off part of the position, maybe one of the lots, maybe 2 of them, or indeed if it looks very much as if a position is not actually running in the way that it should have done, then even before a stop loss is hit, one can actually peel off some of the risk and reduce that risk, and maybe just keep it down to even a 0.5% risk that we might be committing at any one time. Now, one of the problems, of course, is that if we do this and start to peel off contracts as some price is moving in our favor by taking profits along the way, then it does reduce maximum profit on a good run. So what I tend to do is to add in. Once something has moved on up, it's probably reached a plateau, it's probably got to the point where the momentum is now dying off. So I'm going to take partial profit. But if then the price does move on back up and it puts in a decent pivot, then there's absolutely no reason why we shouldn't add back in and start adding to the position. So we're taking profits along the way, always protecting profits, always protecting the capital, but then buying back in to make the most of moves as they unfold. So there we go. Let's just look at putting 1 or 2 of these into practice. So let's assume 20 pips risk, and with a 3-unit trade. One approach would be to exit 2 units when the profit equals 50% of the risk. So that implies that if price has gone up now, and it's gone up in profit by at least 10 pips, okay, then what we do is to close 2 units. So we're taking 2/3 profit once we've got at least 10 pips profit, okay. We're going to leave the 3rd unit on at the original 20 risk, and then if price does decide it's going to reverse and come back on us, then we're actually not going to lose anything at all. So if we'd have been all in, all out on this first example there, without doing any scaling out, and price did move up some way into paper profit, but then came crashing back down and hit the stop, then we're down 600. But by doing this, by just scaling out and preserving our capital at all times, we can end up putting trades on and not actually losing anything. Now that's a scalper's very risk-averse strategy. And for those people who do manage to find that their trading account is being depleted or they've got into a string of losing trades, then this approach is one that can actually bring an account back to life. Now let's look at an alternative to that. Let's just look at a minor variation. And the minor variation, once again, let's just look at this self-same technical trade which would allow 20 pips of risk. 3-unit trade. This time, let's exit 1 when the profit equals risk. So the risk is 20 pips. So when and if price goes up to 20 pips in profit, okay, that's 40 pips now away from the stop loss, then what we're going to do is we're going to peel off one lot. So we're going to exit now 1 of these 3 units. 1/3 gets taken out. So we take 20 pips profit on that, move the second, okay, the second unit, the stop goes to break even, and the 3rd unit stays there at the original 20 pip stop. If price now comes back heavily and goes right the way, just slices through break even, slices through the stop loss, again, we end up making nothing, but the all important thing is not actually losing anything. Now hopefully price is not actually going to come all the way back down to the stop loss, but on hope that it's going to turn around and it's going to move on up in the direction that we've originally assumed that it's going to go, then the idea is to close the final unit when a clear reversal occurs. So the profit is going to be taken out of that final 1/3 of the original position. Okay, so you've got 2 very, very risk-averse strategies there that can be followed. And for scalp traders, or indeed swing traders, you can apply it in any time frame. This is one of the best ways to get an account back to life before and until the trader has got sufficient confidence back to allow a slightly wider degree of risk. Yeah, absolutely right, Jez. Yeah, that's right. Or at least you can call it 3 trades, or at least you could open, let's say that you're going to open standard contracts, which would be a 300,000, okay, of base currency trade, and in this example, you'll peel off 100,000 once it's 20 pips in front, and then move 100,000 of the stop loss to break even, leave the final 100,000 where it is, and away we go. The alternative scenario is to use spread betting, where you're not calculating the 100,000 of a lot, but you're just doing, say, a $30 spread bet, or indeed a $3 spread bet. You close $1 once it's 20 pips in profit, set the next 1/3 to break even, and leave the original 1/3 where it is. So Again, it implies that you've got a platform that does enable you to actually split your bet size or indeed your trade size. And most platforms do allow that, of course. Right, now let's just get down to getting some rules on paper that we can actually follow. So you've got to have a solid written plan, and the important thing is to never deviate from that plan. Now, there are obviously going to be times when that plan is going to need to be modified. It's going to be a good idea maybe to look at it dynamically to see if it is actually working out, but also have some what-if scenarios written into the plan. One of the biggest problems that traders face is that when prices move really, really rapidly, they've got to make quick decisions, and a quick decision can sometimes be the wrong decision. So if there are some pre-written out scenarios as to what could happen, then the trader will be able to sort of automatically react rather than panicking and worrying and thinking, oh dear, what am I going to do now? You can just act instantly. So let's just look at this. What if price then gaps up against my position before a stop loss is in position? So what would one do? This is against a position without a stop loss. Well, standard rule, close it immediately at the market, or indeed hold and just check if price has actually gapped up to potential resistance level. Okay, so you've just got an answer for it. So you're going to choose one of these, but also you can't do both. And of course, the hold scenario then assumes the analysis has identified where upside exists. Now, pretty well all currency markets, particularly cable, which I probably trade more than anything else, frequently will put in false breakouts. You tend to get false break reversals. So you get a nice little clear entry breaking through, might be a nice little head and shoulders, double top, something standard sort of pattern. And what happens? Price just breaks through, breaks the neckline, looks as if it's going to go charging away, but it immediately reverses. Now that happens time and time again. So the breakout trader needs to have an alternative scenario, which is that the breakout is not actually going to work, and that it could possibly turn into a false breakout. Those false breakouts frequently will actually turn at fib levels. They'll turn at resistance levels. They'll turn with a particular type of shooting star or hammer candle. So provided the trader is aware of that and can be prepared to just jump very, very quickly to jump ship and then get on the right side of the trade. So now let's just look at a rather more pleasant approach. What if the price very rapidly moves a long way into profit, way beyond the scale out level? So what do? Do you hold on for more, or do you close the first unit as the momentum dies? Well, my approach is that I always will scale out as that momentum dies. What if the market then whipsaws? Now that happens typically around about the news. In fact, it happened last Friday when we have the non-farm payrolls. It happens so often. The market will whiz one way, then the other, and it stops me out of 3 trades in quick succession. Do I go straight back in with the 4th trade? Or would it be wise just to stand aside and wait till the trend develops? Well, for me, it's always the latter. Indeed, I never ever trade directly on the news these days. So there we are. By answering these questions and just writing down on that trading plan what actions would be taken, then the trading can become a system, and the emotions don't need to get involved. And it's the emotions which are the things that kill trading accounts. Right, let's just look at an example. Here we have this nice little run on the euro, where got a superb little top there. Nice little neckline, head and shoulders top, failed breakout. It's a false break reversal with a head and shoulders and a multi-point reversal pattern. So it's got everything, this one. Price actually did move on down, then it popped up, and as you can see, that little rally up then resulted in price moving all the way on down. So there we go. Let's sell 3 units, and let's do that at 129.45. Yeah. So we've got an entry there, which is entering just as the false break is recognised and the multi-point reversal is breaking down. Okay. Got a risk of 40 pips. Then as price moves on down, we're going to buy back 1 unit. Okay, going to buy back 1 unit as the momentum is dying here. Stop on the second unit comes to break even. So we've got to stop at break even, 129.45, just about there where the pointer is right now. So now we can't lose. We're on for a free trade. Okay, we've got that comfortable position. Then on down it goes. The correction low is taken out. Both stops now are going to come down to 128.41, and it just moves on down. So we've locked in profit on 2 units. 104 pips profit is locked in. Buy back second unit, 128.25, as we start to get something of a little bounce on there. And so we've taken some profit along the way now, taken quite reasonable profit along the way, and we're then just holding the final third and going to just hold it and see where it's going to run to. Finally, it just goes on down, 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 just keeps running down, and then eventually we're going to get a reversal. What have we got? We've got this whole reversal pattern here, which is, as you can see, we've got a bullish candle just down here, and the final clincher then is that hammer telling us that that move is now well and truly over. And it's also a 5-wave move, following the Elliott rules. So there we are. That's an idealized trade there, where profit is taken along the way and risk is taken off very, very rapidly, and we're just preserving profit the entire time. Right, now let's just look at the behavioral aspect of life. Now we've got to commit these trading rules to memory, and in order to commit them to the brain, then we've got to repeat them. Now, I don't know if any of you guys managed to learn your tables at school and you did it by rote. You just repeat it again and again and again. You can visualize the rules. You can meditate. You can chant every day, but just do whatever it takes for your rules to become totally part of you and actually ingrained. And of course, you know, there are bad habits which are always lurking. There are good habits. And the habit of discipline of good trading is following the trading plan and just doing it over and over and over and over again. Really, until it becomes quite boring. Now you want to record every trade. I record every trade that I do. Every weekend I look back on the trades that I've done in the week. Look at the charts, compare it, and be clear on which trade actually followed the plan or actually didn't. So those bad habits, they're just waiting to pounce there. And what I invariably find is that when I'm analyzing the trade, is that those trades that didn't work out, some of them actually followed the plan, but every now and again, I find that I've deviated from the plan, and invariably, they're the trades that are actually losing money. So, what are these bad habits? Things like moving stop losses, averaging down, not taking losses early, hoping a loss is going to reverse and come round into a profit. Trading on hunches, listening to gurus and the tips, you know, the list of these just goes on and on and on. Right, now let's just look at the comfort zone. Now we've all got a comfort zone, and we've all got a very personal inner sense of our own self-worth. And psychologists say that for a good many people, our sense of self-worth and value is based on whatever our parents actually earn. So if our father earned a particular amount of money, relative to whatever the time was, of course, then those that earn actually more than their father start to get into an uncomfortable situation. Those that earn less are in an uncomfortable situation, and the median is what the father earns. Now, some people, of course, have a very strong sense of personal value, whilst others are going to have problems with self-esteem. And consequently, their personal sense of self-worth is going to be adjusted by that personal level of self-esteem. And of course, that is going to reflect in how successful or otherwise our trading is. Now, new traders who are faced with either making or losing a substantial amount of money are going to find that the decision-making process can be impaired. And at times of stress, our base instincts, they're just embedded in our subconscious, can just take over from whatever rational thought that we might have, and we can find ourselves taking some really out-of-character action. I mean, those people who've never ever been used to seeing probably, $5,000, $10,000 just shotting up in their account, if they see this happening over, say, just a half an hour, that could take them way, way out of their comfort zone, when all they've been used to is a pretty average wage, probably making $40,000 a year or whatever it is, and by seeing themselves making or indeed losing, say, 10 or 20% of that much per year, but seeing it actually happen within a day, then that's going to play havoc with their comfort zone. Now, the subconscious will take over. The subconscious will just result in the fight or flight syndrome. So a trader who is sort of losing a fair bit of money, fear is going to come in. The trader is going to be making an awful lot of money in that short space of time. Greed is going to be the thing that takes over. And both of those are really irrational. We actually haven't sort of worked those through necessarily. And of course, it's very, very important then to have a set of rules that can be applied that the trader can use when we're faced with those really quite outlook-changing events. Now, some successful traders, they can sort of reach a profit plateau. And above that profit plateau, they keep making losing trades. That again is going to be based on whatever that trader's sense of personal value is. I mean, there were quite a lot of studies based on salespeople who managed to reach an amount of money that they were comfortable with making each month, although they had the potential to make more and more sales and make more and more money for themselves. So they would probably work pretty hard in the first sort of 10 days of the month. They would make whatever they felt was their rightful amount of money that they should earn in that particular month. And then they would just spin their wheels for the rest of the month. And so it can be with traders. Now, the other side of the coin, of course, is that unsuccessful traders can fall into a cycle of losing trades that can eventually just blow an account. Now, large drawdowns then and exceptional profit runs can have the same effect. Move down to the comfort zone, the subconscious will have an invisible sort of guiding hand, and it'll move the trader back into the comfort zone. So it's essential to be aware of what the subconscious is doing with us at all times. It's guiding us to do things that we not necessarily, our rational mind, would want us to do. So we've got to work on the subconscious at all times. And the best way we can do that is by creating useful habits, which are things like always setting stop losses, reducing a position size to the no stress level. If at any time you're trading and the trader finds that he's on the edge of his seat, or that he's getting the sweaty palm syndrome, then stress is creeping in. So the important thing then is to reduce the position size back to the no stress level. Indeed, one of the UK London trading houses actually introduced a little device that traders can hold in their hand, and it detects the amount of humidity or the amount of dampness in their hand. And if their hands are starting to get damp while they're actually trading, it sets off a little alarm. And the little alarm is then reminding them that they are trading too heavily. Right, well there we are. That's a process then, chanting and repeating basic trading rules in order to stop the stress and to get the subconscious under control. But of course, now and again, that trader right up the top there, the successful trader reaching the profit plateau, and of course the beginning trader who's just starting to cotton on how the markets work, then it's a question of being prepared to move out of the comfort zone and get used to taking some larger positions. But beforehand, mentally work on accepting a greater degree of personal value. Now let's just look at what our minds are hardwired to do. Very successful psychologist, this particular guy has written a good many books, Daniel Kahneman. He did a survey, and he did a survey with a whole series of people, and given a choice of taking a guaranteed $1,000 on the table right now, or indeed a 50-50 chance of either having $0 given or maybe a $2,500 gain, most people went for the safe 1,000. Now you can certainly understand that. So they played safe. But then he turned the tables, reversed the whole thing. Given a choice now of an absolutely rock-solid certain $1,000 loss or a 50-50 chance of now increasing the loss to $2,500 or indeed no loss at all, which would be the ideal scenario, the same people preferred taking the 50-50 chance. So what actually happens there is that we're risk averse in seeking gains. So if we've got a gain that is moving on up, what we're likely to do is to go and chop that gain whilst there could be an awful lot more to be had. But we're quite prepared to risk one loss becoming an even bigger loss. So what we've got to do, we've got to recognize that this is a standard humanoid trait and work on reversing it. And the only way we can do that is to hardwire ourselves and be prepared that what we've got to do is to reverse this idea of gambling with losses and never ever gamble with losses, but just cut them immediately. But be prepared to set stops at break even and let profits run. So there we are. We're all emotional beings. Winning and losing, associated fear and greed can play havoc with any one of us. With any one of us. And much of the time, it happens without realizing that it is going on. So the psychologists, as we just said, are naturally inclined to hold losing positions and take small profits far too quickly. By speaking to brokers, spread betting companies, which they generally don't want to sort of share this information, but the majority of people do just that. They will take loss after loss after loss interspersed with small profits. And the average life of a spread betting company customer, or indeed a broker's customer, is around about 6 weeks. They blow themselves out. Small profit, big loss. Small profit, big loss. Traders have got to reverse that. Fall in love with small losses. Every small loss will move me closer to consistent profit. And as our subconscious guides everything that we do, it responds then to being fed positive self-talk in reinforcement of the rules. Now, a couple of books I strongly recommend. Mark Douglas's Trading in the Zone And the other one, which is based on Arikiev's experiences as a psychologist in various trading houses. His book, he's written quite a number of books, but his book Trading to Win is really excellent. And it's full of stacks of examples of traders that he's worked with who've either got into losing spiral or they've reached the profit plateau. And it's a book that most people can relate to. And certainly those traders who've been trading for a little while will instantly recognize many of the scenarios that he talks about within. Right, okay, got to set some goals and targets. Now, when learning a method of trading, then it's important to not butterfly and just jump from one to another, but to learn it inside out, to the point that the trader is going to become confident with it. And confidence is one of the most important traits of traders. The trader who goes into the trading room who's concerned, diffident, sweaty palms, and all the rest of it, is going to make wrong decisions. The trader who is quietly, coolly confident and is not going to be risking a fantastic amount of money on every spin of the dice is the one who's more than likely to actually make money. Those people who are very, very good at trading are those who can take that on board. And they need to be humble in front of the markets. The personality type that doesn't seem to do at all well are those who are very, very strongly opinionated. They may well have been a sort of a high roller in business and other walks of life. And those people find it really, really hard to relate to what the market is doing because they've been so used to calling the shots, dictating movement within their business, within their lives, within their family. And a strong degree of humility is what traders do need to develop. Now, there's no reason why you have to keep on trading. Why not have built in that you're going to trade just a certain number of times per day or a certain period of time in the day? Greater trading frequency can very often lead to greater losses. I've interviewed dozens of traders, and one thing that has come through time and time again, I'm reminded of a trader that I interviewed and also subsequently did a little bit of work with. He was very, very successful, but he was successful only at particular times of the day, and he sort of realized what was going on purely by looking at his trading account, found that he was very, very successful trading in the morning, but he had a habit of giving back his profits in the afternoon. What did he do? It was dead simple. He didn't trade in the afternoon. He just went off, and he was a sporty guy, and he went off, and he was a tennis player, played tennis in the afternoon. Profits in the morning, tennis in the afternoon. Right. One of the goals, important goals, is to always take losses no greater than what the trading plan is going to allow, and also have an amount per week, per day, that I'm prepared to lose. Have another goal, to be profitable, at least profitable at the end of each week. And there we are, just set these daily and weekly profit targets. So if we've got a $30,000 account, then let's go into each month with $30,000 or less. So if at the end of the month we've actually made a profit, in this case, just over 10%, then, we've made this $3,563. So let's just take that money out, start the next month with exactly the same amount, staying within that same risk parameter. But if at the end of the month it drops down to below $30,000, do not add capital. That assumes that for whatever reason we're taking losses and things are not working in the markets for us. So now the imperative is to actually make some money by trading well to get the account back up to the profit-taking point. So you don't get paid that month, nor do you get paid until you start trading better and recoup the losses. Also, the daily risk capital is decreasing as you lose money because it's a percentage of the trading capital. The idea is to stay in the game, not run out of cash and survive the learning curve and hopefully become a better trader. So, how do you go about adding capital? Well, until you're profitable, you don't have to worry about the problem. Once you do have some profit, then you can choose either to live off them, or you can start to accumulate them in a separate account, which I strongly advise. As soon as you're living off profit, then there becomes pressure to actually make profit. Pressure to make profit quite often leads to trying to find trades that don't actually exist. And those trades so often can lead to loss. So there we go. Add them into a separate account. Add to the trading business when the goal is reached. So move on up by setting a trading goal, for example, to make 10 grand, or even a grand, or even 100, no matter what it is. And then when you add that 10 grand, you can add it, the real value of your risk reward percentage will increase, and now you can risk more money, but of course the reward is greater. So that 30,000 account can go up to 40,000, and then gradually one can increase. So there we are, guys. That's just running through that, a very sort of academic look at money emotional trade management. But of course, within here are a whole stack of things which tend to guide us, and it's the subconscious which is the guiding light that we've got to be aware of. Number one, be aware of the subconscious. Number two is to work on the subconscious so it supports everything that we do in trading, and develop that quietly confident trading approach. Okay, guys, that's George now completed. Signing off for now. I'll be with you again next month, and we'll be looking at something which is more specifically market related, and we'll be looking at one or two new techniques. Thanks for now.